I tested 12 popular trading patterns across over 1,000 real charts. Most of them are garbage, but 4 of them, used the right way, actually move the needle. Today I'm showing you exactly which ones, and exactly how to trade every single one. Here's what's coming. How to spot real reversals before they happen. How to catch continuation breakouts before they run. The exact trap that wipes out new traders every day. How to actually use RSI and MACD together in a fully back-tested strategy with real numbers, no cherry picking. Pattern 1, the hammer. After a downtrend, price pushes lower, then gets violently rejected, leaving this long lower wick. That wick means sellers tried to push price down and buyers overpowered them. The longer the wick, the more aggressive the rejection. One of the most reliable single candle reversal signals out there. Pattern 2, the bullish engulfing. Watch the second candle completely swallow the body of the first red candle. That's not a coincidence. Buyers didn't just stop the selling, they reversed it in one move. The bigger the engulfing candle, the stronger the signal, especially at a key support level. Pattern 3, head and shoulders, the most famous reversal pattern in all of trading. Left shoulder, a higher head, then a right shoulder that fails to make a new high. Connect the two lows, that's your neckline. Once price closes below it, the uptrend is officially broken. This shows up at nearly every major market top. Pattern 4, the bull flag, my favorite continuation setup. A sharp move up, the pole, followed by a tight sideways pause, the flag. That pause isn't weakness, it's the market catching its breath. When price breaks back above the flag with momentum, you're catching the next leg of an existing trend. Here's the pattern that wrecks more accounts than any other, the bull trap. Price coils under resistance, just like a real breakout. It pushes through, everyone piles in. Then it completely reverses and crashes back below the level it just broke. Never buy the first candle of a breakout. Always wait for the retest. Let's talk indicators, starting with RSI, the Relative Strength Index. It measures how fast and how far prices move on a scale from 0 to 100. Above 70 is overbought. A pullback becomes more likely. Below 30 is oversold. Sellers may be exhausted. RSI is a speedometer, not a buy signal. Here's where RSI gets powerful: divergence. Price is making a higher high right here. Looks bullish, right? But RSI underneath is making a lower high at the same time. That mismatch means momentum is fading even as price keeps climbing. This bearish divergence is one of the earliest warning signs before a real reversal. Next, the MACD. It tracks the relationship between a fast and a slow-moving average. When the MACD line crosses above the signal line, that's bullish momentum kicking in. The histogram bars show that momentum's strength in real time. Shrinking bars mean the move is losing steam before the crossover even happens. This next signal just needs 2 moving averages. When a fast average crosses above the slow one, that's a golden cross, one of the most widely watched bullish signals on Wall Street. It's not early, a chunk of the move already happened, but it confirms the trend is real. Bollinger Bands measure volatility, not direction. They expand when price moves fast and squeeze tight when the market goes quiet. That squeeze is the important part. Low volatility never lasts. It's the calm before an explosive move. One thing beginners always ignore: volume. A breakout on weak volume is suspicious. A breakout on volume that's 2 or 3 times average, that's real conviction behind the move. Volume is the lie detector of the chart. Let me show you why risk management beats every pattern on this list. This is a real liquidation cascade. Price goes parabolic, over-leveraged traders pile in, then it cracks. Each bounce gets sold harder than the last. RSI crashes into oversold and stays there. Leverage doesn't pick a side, it amplifies both. The traders who survive aren't the ones with the best patterns. They're the ones who size positions so one bad trade can't in their account. So do these patterns actually make money? Let's find out with a real backtest. I ran a simple strategy combining a few of these signals across 90 bars of price action. Watch the entry triangles and exit dots build live, with the equity curve below. Notice it's not a straight line up, there are real drawdowns. That's just what trading actually looks like. Here's the full report card. The win rate isn't some insane number, and it doesn't need to be. Because the winners ran further than the losers cost, the profit factor stays solidly positive. That's the entire game in one sentence. You don't need to be right most of the time. You need your wins bigger than your losses. Let's recap. 4 candlestick patterns: the hammer, the engulfing, head and shoulders, and the bull flag. 1 trap to avoid: the bull trap. For indicators: RSI, MACD, the golden cross, and Bollinger Bands. And 1 rule that matters more than all of it combined: protect your capital first, chase profit second. If this saved you from even one bad trade, that's the whole point of this channel. Subscribe, because next week I'm backtesting 5 more strategies live with the real numbers, no cherry picking. See you in the next one.